Hey, welcome back. Today, we're diving into the really fascinating story of how an industrial giant, Honeywell, is completely reinventing itself. It's a tale of corporate strategy, high-stakes finance, and a pretty incredible bet that pulled in nearly $500,000 in cash right up front. So let's jump right in. All right, here's how we're going to break this down. First, we'll look at the bet itself, what it is. Then we're going to deconstruct the massive changes happening inside Honeywell that make this whole thing possible. After that, we'll get into the simple math that creates a huge safety net. And finally, we'll explore the future of what they're calling the new Honeywell and, of course, the risks involved. So let's start with the what. This isn't just some random number. It's the end result of a strategy that's designed to generate a ton of income by betting on the long-term success of a blue-chip company, a company that happens to be right in the middle of a massive transformation. So let me just ask you this directly. In today's world, how could you possibly generate a 5.5% return on a huge company like Honeywell and at the same time build in a 10% cushion in case the stock price drops? I know, it sounds a little too good to be true, right? But it's really at the heart of the strategy we're looking at today. So here it is, the big number, $440,000. And let's be super clear here. That's not some potential profit down the line. That is the immediate, upfront cash that was collected from a single financial trade on Honeywell stock. So how on earth did this happen? Well, it was done by selling something called put options. Now, I know that might sound kind of complicated, but the core idea is actually pretty simple. You get paid a big chunk of cash today for agreeing to buy Honeywell stock at a lower price in the future. It's almost like you're being paid to wait for a sale. But the real magic is why this bet makes so much sense for Honeywell right now. And that right there brings us to the next big piece of the puzzle. See, to really understand this trade, you have to understand the fundamental story that's playing out inside Honeywell. It's a classic case of unlocking hidden value by breaking a company apart. Okay, to really get what's going on here, there's one key concept you got to understand, the conglomerate discount. So imagine a company that does everything from making jet engines to building thermostats. The market often just gets confused by all that complexity and ends up valuing the whole company for less than what all those individual businesses would be worth on their own. And Honeywell's CEO, he's on a mission to fix that exact problem. And this is where it gets really interesting. Look at this timeline. This isn't some sudden reactive move. It is a deliberate, multi-year plan. In late 2025, they spun off their materials business. The next, even bigger step is to spin off their crown jewel, the aerospace division, in late 2026. And hey, notice the expiration date on that put option? January 2027. It's perfectly timed to capture the results of this entire transformation. No coincidence there. So this slide really just nails the whole strategic shift. Honeywell is basically going from this slow, complex, undervalued giant into a collection of sleek, focused, high-margin tech leaders that the market can finally understand and hopefully value properly.
And hey, the numbers totally back this up. Just look at that aerospace segment, 12% organic growth and absolutely incredible 26% profit margins. This is the powerhouse that's been kind of hidden inside the bigger company. The whole theory is that by spinning it off, its true value gets unlocked, which then allows the other businesses to shine on their own.
All right, so we've got the story down. Now let's get into the how. We're going to break down the simple math behind this whole trade to see exactly how that impressive safety net gets created. Okay, let's just quickly break this down again. When you sell a put option, you get paid cash today for making a promise. And that promise is this. You agree to buy a stock at a set price, but only if it drops down to that level. And the best part, you get to keep that cash premium no matter what happens. I absolutely love this analogy. Think of it like a synthetic dividend. It's a way to generate income that can be way, way larger than a stock's regular dividend, just by agreeing to buy a great company at a discount if the opportunity comes up. You're literally getting paid to be patient. Okay, let's put some real numbers on this to make it concrete. The strike price for this trade was $200. The premium collected for each share was $11. So all you do is subtract that premium from the strike price. That means your actual effective break-even price isn't $200, it's $189. You only start to lose money if Honeywell's stock falls below $189 a share by January 2027. And this is why that $189 price is so darn attractive. This chart right here perfectly shows that conglomerate discount we were talking about. See, Honeywell, at a PE ratio of about 23, is valued far cheaper than its more focused competitors like Parker Hannifin and Eaton, which are trading at over 30 times earnings. The bet is that as Honeywell gets more focused, that valuation gap is going to close. So, you might be asking, what's actually left of Honeywell after all these spin-offs? Well, that brings us to the future vision for the new Honeywell. And of course, we've got to talk about the potential risks, right? Let's be real about it. Man, this quote just says it all, doesn't it? The new Honeywell is going to be a pure play on today's massive megatrends. Think AI in manufacturing, making data centers more efficient, and reshoring supply chains. Their software platform, Honeywell Forge, is designed to be the operating system for this whole new industrial world. But of course, no investment is a sure thing. I mean, trying to break up a giant like this, that's incredibly complex, and there's always execution risk. There are going to be one-time costs, and the global economy could always hit a rough patch. The good news is, these risks are cushioned by the company's massive $39 billion backlog and a really aggressive share buyback program, which helps support the stock price. And that really leaves us with this final question. The Honeywell story isn't just about one company. It's really a blueprint for how these legacy giants are trying to unlock value in the modern economy. By deconstructing themselves, they can become nimbler, more focused, and create some really unique opportunities for people who can see the change coming. The real takeaway here is to keep an eye out for the next great corporate realignment.